Okay, the next one is about relative valuation on this video, right? PE, PB, and PS, and then all different kinds of multiples. How many different multiples? Infinite number. You can come up with your own multiples, by the way. But we try to use something common so that everybody can understand each other, right? What I said was you can propose a new thing, something called, nowadays they say price to dreams ratio. Anyway, why do we feel so difficult when we use relative valuation, but not that much difficult compared to DCF? But there is a reason why, because we get awfully confused when we use relative valuation. By the way, relative valuation versus DCF, let me ask you this question. Which of the following makes no sense? A, valuing Samsung Electronics with DCF. B, valuing your apartment with DCF. Let's say your apartment is 아파트 somewhere in the 대치동 area, 30평 or 30평 unit, right? Would you value those apartment unit by analyzing sum of the part? This toilet is generating, toilet will be generating like $1 million every year going into the future. How could the toilet generate $1 million other than your toilet bowls like flushing, right? Or just water? I don't know what the heck. But let's say the toilet generates certain dollars, and then the living room will generate, a couple of million dollars in the future. And those rooms, bedroom 1, bedroom 2, each will be generating X amount of dollars, Y amount of dollars going into the future. And then here's the sum of the part and whatever $1 million worth. If you say like this, your boss will fire you. Fire you. Yes. What will they say? Forget about DCF, man. The value of the apartment is just, look at the price of the neighboring unit, the similar shaped ones and similar sized ones. If it is, priced, transacted at 10억 won yesterday, it's gonna be your price of your apartment, right? Relatively speaking, is it equivalent price or not? Okay. For every unit of area, 평당 얼마냐? It's like every square feet. How much is it, right? Relative to each neighboring equivalent unit. Is it fairly priced or not? Okay. Follow the average. That looks like just like you. Okay. That's the relative valuation approach, right? So that's it. We are just assuming that the asset is efficiently priced in average when we use relative valuation. Okay. Abuse of language is there. Strictly speaking, what you get by using relative valuation is not really intrinsic value. Okay, 내재 가치가 아니에요. It's not intrinsic value, but people sometimes just use the terminology intrinsic value even when they use relative valuation method. It's not an intrinsic value. Intrinsic is something you get using DCF only. Okay, that's the discounted cash flow. I mean, DCF has an advantage in the sense that it makes you study real hard. Okay, I have a group of students like the corner, right? The students spend so much time doing the DCF analysis. The good thing about it is it makes them expert in those industries they study. They spend a whole semester studying about whatever industry they focus on. And then, what for? Well, because they are doing DCF primarily. For that part, they need to understand the nature of it. The capital expenditure pattern and depreciation rules they use in different industries, and then patents and all these kind of things are very industry specific. Up to the point when my friend interviewed one of my students over there, my friend in a distressed asset group of a certain bank, right? He said, wow, the guy is so expert. How were you able to train this guy in this thoroughly? I didn't train them. They were working on their own, right, in the corner. So that's an advantage of DCF. It enables you to be an expert in a certain industry so that you can convince other people, like with your own knowledge over there. That's intrinsic value-based argument, okay? Scientifically, you get down to that economics, and then, you can argue your way over there. But relative valuation, let's say, forget about that part, right? It's more light-hearted way of doing it, right? It's just like a quantitative approach of lining up everything. You're going to see why I say this one. Now, it's not totally forgetting about the fundamentals, because you will realize that the fundamentals still matters, but it's not company specific. Or in relative valuation, you don't spend that much time studying on the fundamentals too much, right? The essence of relative valuation. The relative valuation, the objective is to value assets based on how similar assets are currently priced in the market. Okay? To do relative valuation, what do you have to do? Well, you have to identify comparable assets. Apartment, 아파트 here and there and there and there. Not the apartment in, other places like Gangbuk or somewhere else. Something it has to be in the Gangnam area, right? Equivalent, comparable assets, and then compare it. For company purpose, well, similar industry would be most relevant. But you can open up the scope so that you can compare every stock, thousands of stock, right, using PE multiples. You can also do that, okay, in a rough manner. And there is a lot of flexibility. There's no straight correct answer. It's a lot of room for flexibility. And then convert these market values into standardized values. And the standardization is important. This process of standardizing creates price multiples. The idea is this, right? The idea is this. Samsung Electronics is right now about 60,000, 70,000-ish, 7만 won, kind of, or should I say $60 worth. Okay? $60 worth. Warren Buffett's Berkshire Hathaway is priced like let's say it is per share. How much is it? Couple of $1 million, or let me see. Berkshire Hathaway stock price per share. Berkshire Hathaway stock price. Class B. No, Class A. Class C? Class B. Yeah. Let's see. Yes. Berkshire Hathaway's stock price, 431,000 US dollars. Ridiculously high, right? 5억 won. Oh my God. Whereas Samsung Electronics is like $60 worth. Does that mean that Berkshire Hathaway is like more than 5,000 or 6,000 times more valuable company than Samsung Electronics? And the answer is no. Why do we have such a huge difference in price per share between Berkshire Hathaway and Samsung Electronics? Because the number of shares outstanding varies across different companies. Like Berkshire Hathaway's, they have minimal number of shares outstanding. Okay, small number. Divisor or denominator is very small. Market cap divided by the number of shares outstanding is price per share. Can we compare any company by this price per share? The answer is no, because of the denominator. Number of shares outstanding is very, different depending on the companies, right? And then, can we compare the companies whether it is doing good versus bad based on this market cap only? Well, it depends. We don't usually compare it that way. Of course, you want the higher market cap, the better, but based on what fundamentals? You need some comparable figures as a denominator. You have to standardize it somewhere, right? Somehow. Let's get back to this price per share concept over here. Price, right? Price multiples. This price, Berkshire Hathaway versus Samsung, you cannot compare directly. But you can compare still by dividing each price per share by each company's earnings per share. Dividing this price by EPS, earnings per share. For a given dollar of net income that you generate, that the company generates, how much are the investors in the market willing to pay for that stock, right? For a given dollar of net income, right? Shouldn't it be equivalent? Right. For a company like Samsung Electronics, $1 of net income, like, how many times is it? It's 12 times, right? Then shouldn't the Berkshire Hathaway be giving the same, evaluated at the same way, so that the whatever $1 of net income they generate, shouldn't they also be providing? I mean, shouldn't they be evaluated as 12 times of the net income? Yeah. But having said that, the Berkshire Hathaway's PE ratio over here is only 6 times. Okay, 6 times. Samsung Electronics symbol. Yeah, PE ratio 15 times. So you see immediately, right? For a given dollar of net income, 2 different companies are evaluated differently. You can make a fair comparison, right? By standardizing the way of comparison. The price divided by net income or earnings per share, PE ratio. Okay? For a given fundamental variable, how much is it evaluated in the market? That's the idea. Okay? Compare the standardized value or multiple for assets being analyzed by the standardized values for comparable assets, controlling for any differences between the firms that might affect the multiple. Yeah. Now, relative valuation perspective. The thing is, the analysts in the industry, they seldom use DCF, right? They primarily use relative valuation. Why is that the case? Because it's easy to communicate, right? I told you before, right? Samsung Electronics, 15 times PE. And then you call up the person, you can call up a fund manager and say, you know what, you have to buy Samsung Electronics because on average, the PE in the market is like 20 times, but it is now 15 times only. So it's going to go up to 20 times soon. And how much time did it take? 20 seconds or 15 seconds. Instead, if you try to convince the fund manager by saying, DCF valuation, I use beta for Samsung Electronics of something, and then risk-free rate of something, and already you spent 15 seconds, and then the fund managers will say, hang up the phone, man, I'm busy. You didn't even say what's the fair price it should be. So there's a trouble with DCF, but relative valuation, it's very easy to communicate. Right. And then there's another reason why the Wall Street fund managers and then the equity analysts, they try to use relative valuation much more frequently, because fund managers, they don't have long time horizon. Their, professional lifespan is short, and also they're evaluated every quarter, their performance, or every year at least, right? So DCF valuation, that's good, but when will that true value be realized? Maybe in 5 years horizon, 10-year horizon, we don't know. And the DCF valuation, you have to sometimes assume that you are Warren Buffett, so that you will be able to kick out the CEO and you will be the catalyst of change, right? So that you put your friends on that position of CEO and make us necessary changes to deliver the price, deliver the true value that you are imagining. But usually the fund managers, in 99%, they don't have this kind of capabilities, I guess, right? So they are more passively investing it, so they don't care about it that much, and the relative valuation is very handy for that purpose. So that's why. Yeah. And then the relative valuation is very often used, and then it's frequently used as a final decision tool. At the end of M&A valuation, they will say, like, how many times EBITDA would you pay? 5 times, 6 times? Oh, that's EV to EBITDA kind of multiples, right? The CEOs or the guys with money, they like to do it in easy way, right? Not limited attention, but bounded rationality matters over there, right? The more complicated it is, the better, isn't it? Not necessarily. in the end, anyway, the true value is not observable anyway. So it's like a bounded rationality way. It's like 5 times EBITDA or 6 times EBITDA. Should I pay it 10 times? What? No. It works like this way. Anyway, while there are more discounted cash flow valuation in consulting and then corporate finance, they are often relative valuation masquerading as discounted cash flow valuations. You have to, be watchful about this relative valuation, and then you'll have to use it. Okay, the conceptual issue, right? Conceptual idea is this one, relative valuation. Here's a time horizon. Going into the future. Right now, you are standing over here. And then line up all those stocks. What you have on the vertical axis is, let's say, PE multiple that you choose, right? If you are interested in PE, let's say. And then thousands of stocks you can line up. Okay, based on the PE. And then the idea is that the average of these is always efficiently priced, fairly priced. Okay, market efficiency holds every minute. Okay, bubble or bust? Doesn't matter. Let's assume that it is just fairly priced. Okay? Oh, that's not fair. That's not right. Sometimes it is bubble in these days. I don't care. Fund managers, quarterly, right? It doesn't matter. And then all that matters is, relatively speaking, which one is overvalued and which one is undervalued. Whatever is overvalued, I'm going to short sell it. Whatever is undervalued, I'm going to long it. Long short portfolio, you can make it. And then the idea is that pretty soon it's going to converge to fair level. Okay? Hopefully within a month or quarter or less than a year, right? And then what if the time moves on, and 1 year later, and then the average PE level goes up? It doesn't matter. Let's say that this is efficient level. Okay, bubble or bust, I don't care. Everything is efficient. Every time it is efficient for the average level. Is it in a bubble or not? If you're 3% TV, right? Some people always say it's not a bubble. It's a new state, right, that we are living in. So short-term oriented, like fund managers, doesn't matter whether it's a bubble or not, right? All that matters is, again, which one is relatively overvalued or undervalued. Relatively bubble for these stocks, relatively crash for that stock. That's something you can make sense for relative valuation guys, right? So the idea is, like, again, in the short run, pretty soon they will converge to an efficient level. So that's the basic idea of relative valuation. And then pairs trading. Hedge fund managers talk about the pairs trading. The idea is focus on specific industry, motor industry, Hyundai Motors, right? There would be tens of different companies like Toyota, Honda, and then the GM, international motor companies. You can line up based on their PE ratio, and then you can identify which one is overvalued versus which one is undervalued. What do? The idea is that they will converge to average. Okay, the average may change, but their relative stance will also converge. Okay, so what's the idea? Short the ones which is identified as overvalued, and then long the ones that are identified as undervalued. Long short position you construct, and then wait, and then over time it will converge to average level, and then you will earn money. You will make money. That's relative long short strategy. Okay, for that purpose, you need to identify, you need to use a multiple in whatever way, PE, PB, or PS, whatever way. Right, so that's the idea. What are those most frequently used valuation technique? PE is by far the most frequently used ones, right? Long history already. People have been using PE ever since like the 1930s or something. And then the next one is EV to EBITDA, and that's residual income. That's more of DCF. Over here, DCF using our free cash flow methods and the dividend discount kind of things. You don't need to worry about this one. But whatever you see / that's relative valuation. And EV to EG, what does that? Price to book value. This one is my favorite one. And then The other ones, you don't need to worry about that. Google search it basically, and then you will be able to find out the definition of it. And then I tell you, so many analysts come up with new valuation multiples, so you will have to, Google search it every time anyway, and then try to critically understand it, and then most probably you will reject those new multiples because they are more likely to be bullshitting, and then 약팔어 kind of, new kind of multiples they try to sell it to you to lure you, and then buy the stock and sell the stock and then make a transaction cost for them. Transaction revenues for them. But you'll have to critically understand it and then reject it or select it depending on your understanding. Anyway, so price to dream ratio is a good example that happened recently. Anyway, multiples are just the standardized estimates of price. You can standardize either the equity value of an asset or value of the asset itself, which goes in the numerator. So for this part, let's discuss it further in my next video. So wait for that.